Well, that was a really interesting presentation and one that is of relevance for many of us watching. And I'm delighted to transition into a conversation with relevance for almost all of us, which is with Brian Brooks, the the acting comptroller of the currency, who's really been at the forefront of a number of initiatives that have worked to reshape the conversation on cryptocurrency here in the United States. And with it, really conversations on banking and the business of banking. Ryan, thanks so much for making it.
Chris, thanks for having me. It's a great to see you here, even with the screen in the middle of it.
Right. Thank you so much. I think we can just jump right into it and talk about some of your agency's work on crypto. I mean, you have been, I think busy is an understatement for really the work that you've been able to do in the last couple of months. And recently you issued a letter clarifying how banks can provide custody services for customers' crypto assets. And in that letter, you sort of clarified that where banks can hold reserves that back stablecoin held in sort of hosted wallets, there were certain kinds of standards that were announced. I mean, why were those moves necessary and what did they accomplish?
Well, so Chris, first of all, thanks for that question. And I'm really glad that you're spending some time on crypto here, because I think that the macro thesis of crypto and the future of crypto is probably not well enough understood or thought about enough by people who are in kind of mainstream finance. So I'm going to kind of come at it from that perspective. What we're trying to do with these letters is to solve the problem of banks over the last 4 or 5 years have basically treated crypto as though it was like a pawn shop or, as some other kind of, a drug dispensary, some other kind of disfavored business that can't be touched. And the truth of the matter is that, like with any new financial asset, there are very, very strong positives. I'll talk about those in a second. There are also risks, and government has just not said enough about either the positives or the risks to create any kind of a safe framework in which banks felt comfortable operating. And so what we're trying to do is to, on the one hand, clearly articulate where we think the most important risks are. And, among others, we think those are in the world of money laundering and BSA compliance and terrorism financing. Those are real risks, hence the language about hosted wallets. But on the other hand, we also do see a future where decentralization is very likely an unstoppable force out there. Decentralized networks, by definition, are cheaper, faster, and more resilient than any kind of centralized structure. And now that the technology exists to make that possible, it seems not only good, but inevitable that those things will arise. So our point was, let's identify the risks. Let's also articulate that we believe there are strong use cases for these things, and banks should feel free to participate so long as they can adequately manage risk. Weirdly, no financial regulator has ever said that before. So you'd think this would be easier than it is, but that's where we are. And there's a lot more we need to say about this. There are certain kinds of tokens out there that present privacy and law enforcement issues. We should opine on what we think about those things. There are stablecoin projects, located abroad that may or may not present monetary policy challenges to central bankers. All of these things need some attention on our part, and our hope is to be able to go through those one at a time.
I know you well enough to know that you've got to have bigger ideas. I know that you have bigger ideas about crypto than the custody, crypto custody and stablecoin deposits. And as I said, this goes to questions not only about this particular product, but about banks and banking and the like. So from that standpoint, from that financial standpoint, you had sort of signaled what's the big picture in your mind for crypto's use case in terms of the federal banking system. Our earlier panels, some with our earlier panel coming from Asia, as well as with some conversations with central bankers in different parts of the world, we're trying to opine sort of what the use case would be, also in light of the values of different countries that could be potentially issuing them. But when you think about a stable coin, and crypto more generally, what kind of use cases do you see, and what are the next big steps for crypto in the federal banking system?
Yeah, well, so look, there are a number of different theses for different kinds of crypto projects. In the same way that, I always point out the fact that I've got 5 or 6 different communication apps on my phone, right? And they do all convey information, but they're all different. I have, I might have WhatsApp for a reason that's different from email. They're both places I can type information, but I use one sometimes for certain things and others sometimes for different things. So the way I think about it is at the most basic level, we have banks for the same reason that we have the post office. It's for a historically vestigial reason, okay? Once upon a time, in a pre-technology era, the only way to move money or information from point A to point B was to take all of the money or all of the information and aggregate it in one place. And then you could lend it out to some people and you could collect payments from other people all in that central hub. That's why, if you think back to the medieval origin of banking, it was really to finance the great wars of Europe, where you might have a king of England trying to finance a war with the Duke of Padua or whatever, and they didn't know each other. And the people who wanted to finance that didn't know each other, and you needed some central trusted ledger keeper. That was necessary at a time when we didn't have technology, but now we have technology, which may mean that we don't necessarily need either the service of a central ledger keeper or the aggregation of all the money in one place to be borrowed and lent, because the technology makes it immediately possible for you and me to transact directly, even if we don't know each other. We used to need banks for that, but now we have technology for that. And so at the most basic level, that's what's going on. When you talk about stable coins versus when you talk about Bitcoin versus when you talk about privacy tokens, these are all doing different things, much like the communications apps on our phone. So if you ask me what's the thesis for Bitcoin, the thesis for Bitcoin is one day it's possible that America and Europe and other places will adopt monetary policies that look like Venezuela's monetary policy, and government issued currency will no longer have value because it will be debased, right? As Brad said on your previous conversation, at some point there will be real inflation in the system. So that's the thesis of Bitcoin. It's not supposed to do anything other than be rationed. That's its core value. Stable coins are kind of different. The idea of stable coins are, hey, we could take something that has a knowable value. We could either back it based on an algorithmic activity, or we could back it based on dollars in the bank. But we could take this thing that we know has value and we could internetify it, right? We could make it so that it's programmable and instantaneous and doesn't rely on the internal workings of a bank to transact. So it's like we know people want this because they already sign up for Zelle and Venmo. But the problem is Zelle and Venmo aren't interoperable with each other. They're closed loop kinds of systems. Stablecoins are all about the concept of the internet, fully interoperable. You don't have to be on Zelle to receive a Venmo payment, right? Here, I can transact with anybody who's connected to the internet, and that's a good thing for stablecoins. And then ultimately, really, Chris, I think the real use case of crypto is in a world of increasing integration and increasing globalization. It really makes no sense to think that anyone across borders who wants to transact with each other has to pay a foreign exchange fee to change yen into dollars, let's just say, and then also to pay a money transmitter for the act of hitting the send button and sending that money across a proprietary platform. Imagine if there was a single token that was recognized on both sides of that divide. And when you received it, you could cash it out into your local currency. And when I received it, I could cash it out into my local currency without the need to change it, right? Those kinds of things occupy so many trillions of dollars of friction in the system that it's, when people say there's no killer app to crypto, I sort of think, no. The killer app of crypto is the simplest application, which is avoiding frictions. That's what it's all about, much as the internet did for sending information.
You talked about sort of, or you conceive and think about the use case for crypto, really from the standpoint of decentralization combined with, I guess, a kind of interoperability, especially in the case of stable coins. But writ large, I guess crypto then is obviously one of those tools fueling the decentralization of finance or DeFi. And you've observed on many occasions that the other sort of force reshaping banking is something that you describe as unbundling, right? And that really goes to what you were just mentioned in terms of the historical sort of evolution of the origins of banking, and now you're trying to sort of identify or think through what banking looks like now. But I think let's try to go that direction a little bit more explicitly. What does banking look like for you after unbundling? Sort of post DeFi. What do you see from an operational standpoint in terms of the place of banks, right, in the banking system, and literally what it means to be a bank, and then what do you think consumers would then be able to look forward to, and the challenges that arise?
Yeah. So Chris, here's how I think about it. And I think you're exactly right when you say, what does it mean to be a bank? Because I think the nomenclature sometimes gets in the way of having this conversation. So let's start with first principles here. Human beings need financial services. They don't need banks. Banks are entities that exist among other entities to provide financial services to people. So when I say that, what do I mean people need financial services? Well, it's like most of us could not afford to buy a house if we had to pay cash for it. You have to be super rich to be able to just write a check for your house. And so we need someone else to float us that money for a period of time, and we're willing to pay them a rate of interest on it. So we need lending like that. Businesses sometimes need leverage in order to achieve target rates of return. So again, they need to borrow money from someplace in order to do that. People need to go to college. That costs money. Many of us take out student loans to go to college. Or, we need to pay the babysitter and we want to write her a check or send her money from an account. So we need some place to process that payment, but we also need some place to hold our money in some safe way, which we call deposits typically. Those are things we need to live our lives. The companies that have historically served those needs are called banks. But the reason that those were the kinds of companies who served those needs was because, again, in a pre-technology era, we needed one place to hold all of the money in order for it to be efficient to provide all of those other services. And so banks could gather deposits on a low-cost basis and then use that giant amount of money to make loans and do all kinds of other things. In steps technology. Suddenly, Chris, it is possible for you to just go online and say, hey, listen, I've got $10,000 here, and I'd like it to earn 5%. Does anybody want to take my $10,000 and pay me 5%? And the algorithm will find someone who does. And all of a sudden, there's no longer a value in the bank aggregating all of that money together because the technology is substituting for the aggregation function of banks. Whoa, right? And if that sounds complicated, just come back to the post office analogy that I usually use. Back in the day before there was email, the only efficient way for me to send information to Chris across the country was I would take a letter and I'd go take it to the mailbox, and the mail collector would come and put it in one giant repository of all of the thousands of letters everywhere in the United States. And then they would say, okay, all letters going to New York, get on this Pony Express. All letters going to Los Angeles, get on that Pony Express. And they do that like once a day. That made sense before we had technology. But with email, we don't need the aggregation anymore. We don't. We can do it directly with each other and forget the aggregation. That's what it's ultimately all about. So the question, what are banks going to be good for in this era, is a really interesting one. I think the truth is they're going to be good for a lot, just not the aggregation of money necessarily, right? So what I think banks are great for is they're great for value add services. They're great for advice, for fiduciary stuff, for custody of physical assets. And eventually I expect that banks, much as the banks are all connected to the Fed payment system, they're all connected to the automated clearinghouse system and the SWIFT network, I expect that there is a future where banks will be directly connected to blockchains where, they will see that as a payment network and they will become nodes on that network along with all kinds of other companies that are also nodes on that network. If that happens, banks may be able to mint their own stable coins, in a way that would allow them to very readily design value add money transmission instruments, much as, American Express innovated the world of traveler's checks 2 generations ago. So I think there's a huge role for banks, but it's a transformational role because the legacy role of being an aggregator of dollars may be completely disintermediated, which will then allow them to focus on the higher value add, higher profit services that they are best at anyway.
Do you have a sense, you have an insider's view on so many things that are happening both in the banking space and in the blockchain space? I mean, do you have a sense as to, or do you anticipate that transformation being faster, slower? Certainly it would depend on a number of factors. What do you perceive as the major factors driving that transformational change and the degree to which the federal regulators are going to have to sort of grapple with it? What are you seeing in your brief but very active time over at the OCC?
Yeah, well, I'll tell you, Chris, on the brief but active thing, I am a big believer in the idea that it's not about the age, it's the mileage. So we got a lot of mileage on us. But look, the mistake I think that regulators often make is the belief that if something new enters the system, the new thing is risky relative to the old thing, which because it's old is somehow seen as not risky. We need to recognize that the status quo is risky in all kinds of ways. There's a lot of money laundering that goes on in the status quo banking system. There's also a lot of interest rate friction, a lot of chargeback risk, and all kinds of other things. So the first thing we need to get comfortable with is the idea that the status quo is not the risk-free environment. It has a set of risks and benefits, and change has a set of risks and benefits. So we should always be doing a net risk calculation, not like a sort of a standalone risk calculation, is the first thing I would say. And then, where I sort of go is the notion that in the future, for banks to perform the services that people need, they're going to have to sort of compete with other alternatives. That's as true for regulators as it is for innovators. So if you look at the US relative to other countries right now, the EU has published a draft stablecoin framework. We haven't. We've made a lot of law enforcement statements about how we expect BSA and other things to be complied with, but we've said nothing about how, like, these are the conditions under which we think a stablecoin would be a good thing for the country. Instead, we're still talking about a government-built token system that might come online in 4 years. So we're years behind places like Europe in terms of articulating what we think could be a framework to let these things grow. In the meantime, corporate America is not waiting for that. So we've all read a lot about Facebook's Libra project with its various ups and downs. We've read less about other stablecoin projects like the Circle partnership for USDC or the Gemini coin or the Paxos coin. But if you look, Chris, over the last month or two, and you just look at the growth trajectory of these stablecoin projects, these have been doubling in market capitalization roughly every 60 days for the last 6 months. That's an incredible hockey stick asymptotic rate of growth, which tells us the market wants these things and the market will have these things. So we can try to push back as long as we can, kind of like the taxi cab commissions did with Uber, and we saw how that ended. Or we can embrace it and say, look, the good parts of this are very, very good. And we need to come out now and get in front of it by saying, we're okay with these projects as long as they meet these parameters, and only outside the parameters are we going to have problems. We need to be clearer about that if we want to be competitive as a country and if we want to avoid bad outcomes as markets move in the direction they're going to choose.
So let's, we don't have too much more time, so I want to just switch gears to a couple of things that I know people here in Washington, D.C. are thinking about. Many of the objectives of the work over the OCC has to do with increasing financial inclusion. And, when we chatted just last time, I think in June, we had discussed the Community Reinvestment Act. And since then, the Fed has issued an advance notice of proposed rulemaking, sort of starting or kickstarting its own formal rulemaking. And there's some overlap between what the Fed is thinking about doing and obviously what you've proposed, but there are also some important differences. I mean, what would you highlight about the OCC's rule when people are trying to compare the two rules? And what do you see as the primary points of collaboration or overlap, and then where do you see the two approaches diverging the most?
Well, look, Chris, first of all, I appreciate you asking the question. I think the Senate is going to be voting on the Community Reinvestment Act rule today, actually. So it's a really good day to have this conversation. First of all, I'm a big believer in Ronald Reagan's dictum that it's amazing what you can get done if you don't care who gets the credit. So credit where credit's due. I think there's a lot of good stuff in the Fed's rule, and it is very possible that their ANPR will result in new ideas and intelligence that we have not considered that we could look at, next year to make our rule even better. So I think that's terrific, and I welcome what they're doing. At the same time, I'm also a big believer in not letting the perfect be the enemy of the good. And I think everybody gets, and I think the Fed's release shows that they agree, that the status quo is untenable. It's just untenable. And it's untenable because it ignores the fact that banks mostly do not provide their services through branches at the level that they used to 25 years ago when the CRA was last revised. And so we need to get away from branches as the touchstone of geographic assessment areas, and the Fed's rule does that. I think there's also a recognition in the Fed's rule, as in the OCC's rule, that there are groups that were excluded from CRA benefits generally that shouldn't be. For example, Indian country or farming communities, which really were never captured in the original concept of the CRA in 1977, when it was really focused on urban blight and redlining in big cities. So they do all of those things. I would tell you the main area of difference, I mean, there's a few others, but the main area of difference between our rule and the Fed's rule seems to be in the nature of discretion and how much subjectivity should there be in rating how banks perform. That's an issue where I'm happy to sort of put it out there for kind of a general plebiscite. I mean, who thinks it's better for bank examiners to subjectively decide whether a bank has done enough versus telling banks clearly what the rules are and what expectations we think they should meet? It would be sort of like, who wants an objective speed limit on the freeway where you know you're not speeding if you're not driving 75 versus a subjective rule where you can be pulled over anytime a policeman thinks you're driving maybe a little faster than he'd like? I think that question answers itself. But other than the discretion and the subjectivity, the rules are largely similar, which I think is great. And again, if we learn things from their ANPR, we're happy to make it better. We're not here for the credit, right? We're here to make credit and investment more available to the people who need it most.
Right. Well, we only have a minute, but I did want to speak as well to a question that many people are asking, particularly as the economy is sort of decelerating a bit. Not just the United States, but the world is still struggling to manage COVID-19. What's your sense as to how the banking system is holding up? I mean, how well are policymakers doing in balancing different kinds of risk and reward trade-offs? And then secondly, when you look at the health of the banking system, how does that impact your decision-making when it comes to these new financial products and the evolution in banking with obviously the rise of stable coins and other kinds of digital assets?
Yeah, well, that's a lot. So I'm just going to tick off a few things because I know we've only got 60 seconds left. So first of all, I'm going to say the economy is not decelerating. The rate of acceleration is slowing, but we are still expanding. So let's be super clear. There's no deceleration out there. Second, in terms of the system seems to still be okay. I mean, we're coming to the end of the additional runway provided by PPP and other programs. But on the other hand, unemployment continues to fall and consumer spending, retail spending, and other things continue to rise. So I would say that we may thread the needle on this one. I certainly hope that we thread the needle, but that does depend on the economy reopening as fast as the PPP proceeds and other things are running off. Those lines need to intersect at the right moment for us to be okay. Banks are well provisioned, obviously, all of that stuff is good. Then you get to the question on, are we balancing costs and benefits right? Listen, does anybody think we're balancing costs and benefits? Does anybody think that there is any factor driving decision-making in this country right now other than COVID? I think not. And I think as a society, we do need to start having the conversation of, if somebody told us that our mortality risk in the society went from 0.0001% to 0.002%, which would be a doubling, but from one small number to another small number, and the cost of that, of shutting down in order to avoid that other small number, is mass dislocation and suicides and depressions and divorces and everything else. I think you would say we're only focused on one objective right now, and we're a big enough country and a good enough country. We can talk and chew gum at the same time. We can balance risks and benefits. We can understand this virus isn't going to go away if we lock down. That's not what viruses do. So what we need to start doing is understanding, how does an economy live with this thing and thrive and grow? Other countries are doing that. The news this morning is that China's productivity post-coronavirus is almost where it was pre-coronavirus, and that's in less than a year. Ours is nowhere close to that, although the trend lines are good, and it's nowhere close because we refuse to accept that there are other values in society in addition to coronavirus avoidance. So I think we need to balance risks and benefits of all of these things to come up with the right place. I think the trend lines are positive, but I would not say we're out of the woods yet.
Thank you so much, Brian. As always, the OCC has been with DC Fintech Week from the very, very start, years ago. And as always, we're really appreciative of the OCC and you and your support. We're going to be following this discussion and moving forward with a conversation on just how stable are stablecoins. And it'll be coming up right next.